Hey, a little bit of a quieter week this week. Volume's off a little bit, not as big of a trading range. But man, did you see crude production this week? If you didn't, let's get into it this week in oil. Hey, I'm Aaron Kildaw with 30 years of oil trading experience, and I'm trying to elevate your understanding of the market. So stick with me through this quick video, and I'll show you what happened this week in oil. All right, as usual, if you want to go to our website, theoilbalance.com, you can hit the request information button and it'll send me an email. Just ask for this presentation. I'll be happy to send it to you. So let's dig in right now. So a bunch of headlines going around this week. We're still seeing a lot of uncertainty around the tariffs. I think the Canadian tariffs are definitely kicking in. I have a chart for you in just a minute to explain that, at least in terms of the oil market, what's going on. Trump put out a headline on Friday today saying that he can be flexible on tariffs. I think he's mostly talking about China when he said that, but we'll see what happens there. Crude imports down a big chunk again this week. So second week in a row, Canadian imports were down. On the U.S. Russia Ukraine front, it seems like talks are still kind of struggling to go on. The U.S. is trying to work with both parties, trying to get to some sort of agreement. But as those talks are going on, you're also seeing troop deployments, one side trying to take whatever they can as far as territory, the other side trying to fortify whatever territory they want to try to keep. So, still a lot going on. I still have the feeling this could go either way. There's probably too little risk premium in the market. In other words, if something happened, this could escalate pretty quickly, if things sort of in a worst case scenario situation. So on the Iranian front, again, there's a bunch of stuff going on. President Trump sent a letter to the leaders of Iran telling them they had 2 months to come up with a new nuclear peace deal. Again, we'll see what happens on that front as well. Keep in mind that Iran currently exports about 1 million barrels per day, a little bit more of light sweet crude, which is what we produce here in the U.S., especially in the Permian and in West Texas here. So if those barrels were to be stopped or halted, maybe on a global balance sort of thing, we could the United States could maybe fill in and replace those million barrels per day of Iranian crude with U.S. shale oil into the market. Maybe that's something going on in the president's mind or the administration is thinking about. It also looks like the U.S. is really going after the Houthis and at the same time telling Iran not to send munitions, not to send arms to the Houthis. So that is again flaring up here in this last week or so, with some pretty big strikes going on in Yemen by the U.S. And then OPEC sent out a curious thing earlier this week. As we mentioned previously, we were talking, I think, a couple weeks ago about Kazakhstan in particular, where they had been sort of overproducing. They had some new fields come online. They're trying to get that oil to market. And so now, after a virtual meeting of 7 different of the OPEC Plus members, they all decided, well, we're actually going to cut back a little bit and get back down to compensate for the overproduction that we were doing. So how this all sort of fits in with them bringing back barrels to the market, at least to me, is a little bit unclear. It certainly seems like the size of the cuts are bigger than what the increases are. So on average, we're looking at a month-on-month increase of 138,000 barrels per day, with those barrels that OPEC's just trying to bring back to market, which is something they talked about in the December meeting. They were going to push it forward to March. In the March meeting, they decided, yes, they're willing to bring these barrels back to market. And now all of a sudden, a couple weeks later, they're saying, well, hey, not everyone, 7 specific members have been overproducing, and here's our plan to claw that production back down lower. And it sure looks to me like the net result is fewer barrels on the market, not more barrels on the market. So maybe it's sort of a way for OPEC to save face. It's certainly, we had mentioned before that it didn't seem like the market had the capacity to take these extra barrels. There wasn't the demand behind it just yet to take these extra barrels. Maybe this is a way for OPEC Plus to sort of save face and to keep the cohesion in OPEC and OPEC Plus. Historically, these OPEC agreements, they really break down when everyone just starts overproducing. And it's very hard to sort of police and to get back to a more controlled output environment. And so that looks like maybe that was starting again, or maybe the Saudis were afraid that that was starting up again, that different parties were overproducing and just sort of ignoring their commitments that they had made to OPEC or OPEC Plus. And this announcement here this week is maybe a way to sort of rein that back in and say, hey, remember, you're supposed to be producing at these target levels and not more. So that's a pretty interesting turn of events here this week. But in the weekly data, I think there's also some interesting things. So second week in a row, we're getting Cushing draws. So again, Cushing is the location, the delivery location for the WTI contract. So once again, we're below the 5-year range. It doesn't look like by much on here, but we are below the 5-year range right now. So again, the market should be feeling a little bit tight. It's not really in the domestic market. The Gulf Coast inventories continue to climb, even with pretty strong refinery action in the Gulf Coast in Pad 3. So this is there's enough barrels in the Gulf Coast market for now that people aren't too concerned about Cushing for the time being. We are seeing inventories in Pad 2, so again, this is the Midwest, of refined products start to come down a little bit. We have been calling for this and warning about this. That inventories were so high that they would need to slow down refinery activity. And yes, they did slow down refinery activity, but the problem is it's still at the top of the 5-year range. So they've been consuming a decent amount of crude oil, and that's where you get these elevated inventories from. But I guess the good thing is, if you look here at the bottom chart, Canadian flows to the U.S., at least on crude oil, have been severely curtailed over the past 2 weeks, as you can see from this chart. Mexican imports are down a little bit as well. They're just much smaller. So you're looking at 400 or 500 a day from Mexico versus 4 million a day from Canada, at least before 4 million a day was back here the last week of February. So we're definitely seeing fewer barrels of crude come from these countries that we have tariffs on now, especially. And what I've done is I've divided this by the crude demand in the Midwest and the Gulf Coast, right? So Pad 2, Pad 3, to sort of give you an idea, just isolating the imports from those two countries divided by the domestic demand for those barrels. If you look at total imports, especially in Pad 3, it's not quite as bad. It hasn't gone down as much, suggesting that refiners in the Gulf Coast are actually able to find barrels that they need on the rest of the market outside of Canada and Mexico. Unfortunately, Pad 2, just thinking about where the Midwest is, it's landlocked. They don't have a lot of opportunity to import any other crude except Canadian. So I think it makes sense. You are seeing inventories start to drop at Cushing specifically. Overall, Pad 2 inventories are dropping for crude oil as well. So that's going to be an interesting situation here for a little while. In the Midwest, we're going into planting season here. There's plenty of inventory right now for the farmers to get through planting season. That shouldn't be an issue, at least at this point. However, we are running at a pretty good clip on the refining front. Maybe things need to slow down a little bit and compensate for this crude. So we'll see how things go. It's definitely something we should stay on top of. On the East Coast, this is Pad 1B. So this is Central Atlantic, East Coast, basically New York, New Jersey, Pennsylvania sort of region. This is the delivery zone for the NYMEX contracts for gasoline and for ultra-low sulfur diesel. What I'm trying to point out here, so this basically sets the price for the futures market, these inventory levels. So gasoline is actually looking pretty decent. Despite the fact that runs are super low in Pad 1 with a lot of planned maintenance going on right now, distillate stocks are kind of holding in there right at sort of year ago levels, but you can see obviously at the bottom of the 5-year range. So I'm still a little bit, I would still be more concerned about the distillate market going forward, even though we're done with winter at this point. I mean, it's the middle of March. We're not expecting, really cold weather like you might see in January, February. That's sort of out the window. That's behind us now. And we are going into gasoline driving season. You can see last year, about this time, we started to see a huge drop in inventory. That's fairly normal as driving season kicks off and people start to drive around more. So that's sort of the next shoe to drop. It's nice though, from at least from a retail consumer standpoint, that inventories are relatively high going into that, and probably won't be dropping below the 5-year range. We'll see, but those should probably be a gentler gasoline transition than we have seen in previous years. Crude producers, though, are going very strong this year. So crude production continues to grind higher. Second week in a row, we got a 13.5 print on the weekly numbers. And that's just crude production itself. Sometimes you'll hear me talk about the net production number. So there's a calculation you can do that the DOE puts out where they'll give you crude production, they'll give you transfers to crude, so that's like condensate making its way into the crude market, and then there's an adjustment number. So keep in mind, especially on the weekly data, that they're making some assumptions. They're backfilling for demand many times. They're working with sometimes incomplete data, at least on the weekly level. The monthly level data is much more reliable because they have extra time to go back and make sure they understand where sort of everything went. So on the weekly numbers, you can get these huge swings. And this week it was basically the adjustment number that swung up. But the point is, the way the math works out, supply on the crude side must have been really big to justify the change in inventory given the demand that we know about from the refining center and from exports and that sort of thing. So yes, we're looking at really high sort of net production numbers. We're looking at really high absolute crude production numbers. And it will be super interesting here at the end of the month to see the monthly data come out for January and see how things work. Because even January looked pretty strong on the weekly numbers, especially versus previous years where we've had ice storms or something come in and stop production in the Permian. We didn't really get that this year, too. We got a little bit, but not as big as previous years. Which brings us to the WTI chart for this week. Again, I like to look at a weekly chart for NYMEX for WTI. I think it gives you a little bit more of an overview of what's going on instead of trying to get lost in the minutia of, tick versus tick sort of thing. So again, if you recall, a couple weeks ago, I thought the market would hold just below $70. It didn't. It sort of set this new support line down here that we have bounced off of now last week and this week. I think so. That's a pretty decent result. I want you to keep in mind, too, that from a U.S. crude producer standpoint, $70 is your growing production. Things are good. Things are humming along just fine. You get sort of in the low 60s and maybe worst case scenario into the 50s, then you're really cutting back on production. You're cutting back on your growth forecasts. Certainly in the low 60s, you're probably starting to have discussions about the path forward. If you get into the $50 handle on WTI for any period of time, you're probably talking about cutting. You're not going to put the investment out there, right? The reward is not good enough that you make those multi-million-dollar investments to keep production going. You can probably maintain the production level, but you're not going to be growing production in the sort of $50-ish range, which is interesting because in U.S. shale, it takes somewhere between 3 to 6 months, a little bit longer in the wintertime. You're more in the 6-month time frame during the winter, more in the 3-month time frame in the middle of the summer. So if you look back at sort of December, November timeframe, we were right around, call it 71 to 68, even down to 66 a few times here. And that's where we've seen the growth come through. Maybe you go back a little bit further into October, we got this little spike up here above $75, sort of briefly. Maybe some of the crude producers back here in October were making decisions. Yeah, we need to implement more capital. We need to increase our investment. We need to drill more. And that's the fruit of what we're seeing now come through. So again, the point is, in this sort of $70-ish range, either, $4 or $5 either side of $70, you're probably still going to see pretty good U.S. crude production growth, at least on land. And I think we're also scheduled to see some decent Gulf of Mexico production too. That's a much longer time frame. That can take 2 or 3 years to actually come online. So those FID decisions, obviously were made back a couple of years ago. So at any rate, I think we're, at least for now, holding this support line, and the market's getting back again, sort of gravitating towards a $70-ish value. And I think that's probably appropriate. We need to keep a close eye on the Middle East. We need to keep a close eye on Ukraine to see what's happening. But, I think these numbers down here, sort of getting towards the lower 60s, were probably too cheap and unsustainable. So that's what we have in the chart pack for this week. Remember, like and subscribe to our videos. Go to our website, theoilbalance.com, and you can get a lot of this data. Just send me an email. I'll send it to you. All right, so that's our video for this week. Again, like and subscribe to the video. Go to our website, theoilbalance.com. Hit on that button requesting information. It'll send me an email. I'll be happy to send you these presentations, and you can start learning more about the oil market, elevating your knowledge. All right, thank you, and we'll see you next week.